Hi, everyone. Hello, and welcome to the Abu Dhabi Finance Week. I'm Amira Khalid, VP Investor Relations and External Communications at Waha Capital, and creator and host of the Inspiring UAE Women podcast. We have with us today a fantastic panel of esteemed guests to discuss and shed light on venture investment in tech startups. Our expert panelists are, to my far left, Anton Frolenkov, Managing Director and Partner at Winter Capital. Next to him, we have Dr. Khaldoon Tabaza, Founder and Managing Director of Imina Group. And then right next to me, we have Sid Talwar, who is co-founder and partner at Lightbox. Before I get into the questions, can I ask the panelists to give us a quick overview about your funds, what you focus on by stage and funding amounts, and how you ended up in venture investing? I'll start with you, Anton.
Thanks a lot. I appreciate. So we are late-stage VC private equity fund. We run approximately $2 billion USD. Our main focus is on edtech, fintech, health tech, and retail tech industries. We try to focus on BCD stages. This is in a nutshell about us. Thanks.
Dr. Khaldoon.
Thank you. So I've been around for approximately 25 years. Started by establishing the first venture-backed online business in the MENA region, 1995, called Arabia.com. Then the first regional VC in Egypt in 2000 called Idea Developers. For the last 20 years, I've been on both sides of the table as a founder, as well as an investor and as an advisor. Imina Group is a permanent capital vehicle that not only invests, but also builds and engages into partnership with a focus on marketplaces, online marketplaces, and fintech businesses as enablers. I also run a fund, which is a Saudi-focused venture capital fund in partnership with Usul and Bakhit Investment Company. And Ru'a is more of a traditional VC fund that focuses on SaaS, enterprise, fintech, and online marketplaces.
Sid, the mic's yours.
I wish I had so much to say. We're an early stage venture fund, very India focused. We manage approximately $450 million. We're a more traditional venture fund. We have a 10-year horizon. We wish we were permanent capital based on the kind of companies we invest in. We look at consumer businesses across all industries. And we look at around B and C, very similar to Winter Capital as well. That's the ideal space that we look at.
Sid, I'm going to start with you with the first question. So how has the venture capital industry evolved over the last decade?
So, and I think you mean
yes, absolutely.
Regionally. I think this region and India and Southeast Asia are babies right now in this space, and we're very slowly picking up steam, and we're trying to develop both a startup ecosystem while developing an investor, venture capital, institutional capital ecosystem at the same time. So everyone's learning, and to a large extent when you're learning, you kind of look where things have happened. And so a lot of startups, at least as I see that, especially in India, Southeast Asia, and venture funds kind of use American models to both invest as well as try to grow without having either the development or the infrastructure or the understanding of what happens in that region. And so I think we're in the very early stages. We're learning. There are going to be mistakes. We're going to break a lot of eggs. But at the same time, there's a lot of heart involved in this. And I think the grit that's coming from across the different kinds of ecosystems that make up the startup ecosystem is very strong and healthy. And I think that's what's going to drive it going forward. And we're hoping that we're part of that as well.
Dr. Khaldoon, what are your thoughts on the evolution of the VC ecosystem in the region?
So we've seen significant growth in the past few years. In some aspects, I think some parts of the industry went fast and loose. But I would say the most important thing that happened in the past few years is the pickup in traction. So in this part of the world, the number of internet users, the number of smartphone users, and most recently the numbers of
Wow.
the numbers of transacting users have grown significantly. I still believe that the largest opportunity remains in capturing value out of the movement of value in real economies of the sector that are undergoing digitalization. Venture capital is a recipe. You bring talent, you bring capital, and you bring markets and opportunities and problems together, and you come up with successful companies. I feel that the key piece that we're missing now is to get more talent, because capital seems to be more available, and I think the markets are getting there.
Yeah, by the way, it's very good to be last. Thanks a lot, guys. You pretty much mentioned everything what I want to say. So I think that it depends on the market. For example, India is much more mature than let's say Indonesia. Indonesia is very nascent market, and even MENA like VC market just about to be developed or developing, put it this way, and that's why it presents it has so many opportunities at this stage. So look forward to work in this region and to invest into this region. So very, very excited.
Yeah. Okay, so my next question is, a lot has happened in 2022, right? So the Fed has signaled the end of QE. We all know that. Markets turned at the beginning of this year. And then a lot of LPs, as a result, have pulled back on investing. And of course, VC is impacted by that. So given that we're still in post-pandemic recovery mode, and we're also battling global headwinds like rising inflation, interest rates, is capital available in the market to fund tech ventures? And then what is your assessment of the current funding environment? And I'll start with you on this one, Anton.
Thanks a lot. So I think there's still a lot of capital available, honestly. And when I talk to founders, I advise them to kind of split investors into two cohorts. The first one are residents, and the second one are tourists. And what we see across emerging market regions, across whole emerging market regions, is that, like a tourist, they were investing like a lot, like last year or 2 years ago, and they now disappeared. But residents, the funds who are serious about the region, they keep investing. I don't see any slowdown. They keep supporting their companies. They keep investing into new companies, et cetera, et cetera. So I think that it's important to understand for founders, a piece of advice. So who is here permanently, who is here for good, and who can help you to build sizable business going forward? So that's a very important point.
Dr. Khaldoon, what are your thoughts?
So I think in the past, 2 years, maybe 3 years, there's a new generation of VCs that have only been used to the good times. And in a sense, basically trends of investing, rather than investing in problems, rather than falling in love with problems, we started to fall in love with buzzwords. And we started to, invest for namesake investing and invest in herds rather than based on conviction. This is a normal cycle of the market. I've seen the cycles in 2000, 2008, 2012, and 2015. And, if you have a company that has great odds of success, that will create return for investors, the capital is already there. But before we go there, we have to get over the, a stage of protecting existing success and filtering out, tourists or companies that shouldn't have been invested with to start with.
Just one. Actually it's a good point. Like, one point to add here is that many founders, unfortunately, in the last 3 years, were focused mainly on fundraising. They were kind of dreaming about unicorn status, etc., and many kind of forgot about the business, about PMF, and so on and so forth. So, and I think that those companies which have sustainable business model, sustainable unit economics, it's not a problem actually to raise, even now. Okay, subject to valuation, but still, it's not a problem. But those companies who don't have it, yes, obviously they struggle big time.
Yeah.
So actually, I think I like the tourist resident. I think one big thing that we're seeing is most developed startup funding ecosystems are funded by residents. So in America, very little money comes from outside of America from a total capital standpoint versus in China, very, very similar in that money gets revolving around. In our ecosystems that we're discussing right now, the majority of money comes from outside. There is so much money inside right now, but that money is actually looking for exactly what Anton is saying. They're looking for a very different kind of business that's being run in a very different kind of way and valued very differently than perhaps what the tourists have been demanding as far as how to run a business as well as how to value businesses. And so I think the problem isn't is capital is available. The thing is that resident capital, and I'm just stealing your phrases here, but resident capital is readily available. It's becoming much more accepting of this ecosystem, but it wants changes based on how things should be done in that country, not duplicating how things are done in the country of the tourists. So I think it's really a matter of going to the right pool of capital, but also running your company in a way that makes sense for that pool of capital, which, quite honestly, is probably the right way of running your company in that country.
So my next question is, year to date, fintech remains the leading industry within the region, within the MENA region, as far as investment goes. According to a report by Magnet, we've had 94 deals valued at $747 million. So my question to you guys is, why do so many VCs tend to focus on fintech startups? I'll start with you on this, Dr. Khaldoon.
So I view fintech as an enabler, and I believe the strongest juncture in the ecosystem is at the stage or point of intent of making a purchase. This is why I view fintech as an enabler for marketplaces rather than a standalone business model. And I believe that as marketplaces grow, they will start building fintech services in-house. So in my view, if you're a single service fintech business, you should rethink your business model, because very soon you could either become a feature for a bank or a feature for a marketplace. If you're a multi-service fintech business model, then you have a bit more leverage. Obviously, also there's another aspect, which is regulators. If you look at the history of regulation in this part of the world, you cannot have 100 services targeting the unbanked. It'll be impossible to regulate. So eventually you're going to see those consolidating more and more, and it's got to be something that is manageable, and it's going to be something that is significant, that is hard to fail. So while we've seen a huge push into fintech, I believe that it will undergo what other sectors in the market, and this is clear actually in the US. The big players in certain sectors in the fintech industry have become fewer and fewer by the day.
Sid, what do you think?
And I think we're seeing that in India as well. And I think the original rush was that traditional banks are so slow at doing so many things, and they don't want to they don't want to bank everyone.
Yeah.
They're very slow, and they don't want to bank everyone, and they don't know what they're doing, all of which is not necessarily true. But that was the initial gold rush into putting more and more money into companies that could technically use technology to grow fast very easily, because there's such a blind spot in it. And I think very recently there's been a realization in our country. It's happened mainly because a couple of them have gone public, and their valuations have dropped so massively. And the realization is that it's not so easy to do this. It's not so easy to make money off of it, and banks can catch up very, very quickly. And I think the idea that you can make quick money off of it is no longer prevalent. And so I think there will be a slowdown in the number of fintech companies that come out, and the kind of founders that found them. And I think the the quality of founders bringing up fintech companies today have a lot of exposure in the space that they're trying to cover, rather than thinking they can take over a space they don't necessarily understand.
Yeah. Anton?
Well, I think it's fintech space is just too big to ignore, and we have a lot of like old banks, and for whom it's very, very hard actually to digitalize and to move forward. So that's why you have so many fintechs. For example, we have like five neobanks in our portfolio, and they do very simple things, but they do those things in just a more efficient way, be it lending or even money transfer, etc. So and we speak to big banks, and for them, given their size, it's very, very challenging and very difficult to change. So I mean that's why we see so many fintech startups, and that's why we will continue seeing so many fintech startups. And talking about India presents like enormous, huge opportunity, and I think valuations started coming down, which is very good. People started focusing more on kind of business models, more on unit economics versus fundraising. Like I keep saying. So, and I think that in the coming 12 to 24 months, it's just exciting time to invest.
So I'll start with you on the next question, Sid. So from a startup perspective, at what stage should innovators, at what stage should they start engaging with VCs? And then from a VC side, what kind of value do VCs add to the companies they invest in?
It's such a broad question.
Yeah.
There's so many different companies at different times. I would say if I had to give a broad answer to a broad question, you want to engage with a VC when you are determined to grow. Other than permanent capital, you're determined to grow and grow with the liquidity that you're getting from a VC, and then be able to raise more and more money. If you're not ready to go on this treadmill, you probably shouldn't take VC money. VC, the whole idea of the economy of giving money as an institution is that you have a limited time to make that money back. And if I have to make that money back, the company that I give that money to has to be able to grow and be able to raise more money from somewhere that I can also take a bit of and keep going. So if you're not ready to do that, and you want to grow at your own pace, and you don't want the pressure of having to continuously have to raise money post that, you probably shouldn't take, and there are always exceptions to that rule in the ecosystem, but in general, you should be careful to take venture money. What value do venture funds add? Tremendous. You couldn't succeed without venture capital funds. Personally, any company that we've invested in, I'm just kidding. That was a joke. I'm trying to think of the right answer to that question. I think what you want to find is a venture fund that can give you, or an advisor or a board member that can give you time so that you can break down, so that you can be yourself, so that you can not feel lonely. If you're expecting any more from a financial investor, maybe you get it, maybe you get lucky, but 9 times out of 10, you're expecting too much. Is that too cynical?
No. I'll take maybe a different twist on that. I'll say if you have identified a big problem and you have an unfair advantage that makes me convinced that you can tackle this big problem, come talk to me now, even if you only have, an idea about how to make it happen. I care less about, your product being ready, and I care less about you having achieved traction. From there onward, I can help you. But if you're tackling a small problem or an insignificant problem, no matter what, if you've raised, big money, if you've hired an amazing team, if you've developed, a big product, you're never going to attract my attention. I'll also say something else. In this part of the world, building trust is something that's very important. This is why I say, fundraising is a function of perseverance and time. So, you need, come in front of me now in 3 months, in 6 months, in a year, so that I can follow your development over the past year and your development over the past 2 years. That will enable me to make a decision. I will never make a decision because, 5 other VCs have invested and I have a week or so to look at that term sheet, even if your round is the most magnificent round in the world. If I have not tested you and seen your development and completely convinced about your problem, no need to talk to me.
Nice. Anton?
I think as for Winter Capital, given that we're kind of more late stage VC or early stage private equity, I think we really want to see product market fit. We really want to see unit economics. We really want to see kind of revenues. And I think that we really want to understand the market better. We would like to invest into like big markets, big opportunities. Yeah, we want to help the founders to build unicorns. And what we do for founders, first of all, we help to hire C-level talents. I think it's the most important part. Then we help with the strategy, we help with the M&A, we help with fundraising. We're very hands-on. We have a very hands-on approach. And we attend strategy sessions with the founders. We help them to think. And we also help them to communicate with other successful founders in our portfolio so they can grow and develop going forward. So I think that's it.
I think, Dr. Khaldan, you raised a very interesting point about traction. So what's more important for a company, a great revenue model but no user traction, or to have great traction but no revenue?
Favorite question.
So I would say that, basically, companies, first of all, they should find a big pressing problem. Then they should validate it and validate the unit economics in a single market and show that market can continue to grow and become profitable, and then grow to other markets. So I would say, more or less it goes hand in hand. But definitely, if your traction has a clear sight to revenue, then traction means a lot to us.
Sid, what are your thoughts on this?
So I think different companies are different. I think if you're building a social media business, your ability to get users on should give someone comfort that once the users are there, you should be able to bring ad dollars or subscription or whatever it is. I think when it comes to fintech businesses, though, I'm not sure. I completely agree that you need user traction is enough, because at the end of the day, if a user, and we've seen this play out over and over again in many companies in India, beginning with Paytm, which is our probably, let's say, the only publicly traded one, where if you can get the user traction, but are you able to get a user to pay? And if you continue on this treadmill and the users aren't paying, eventually you have a massive user base, but you keep pivoting to try to figure out how that payment is done. So I would say, depending on the industry that you're kind of looking at, you want to try to get the user to pay for something faster, or get a revenue model proven faster than later.
I think like in all emerging markets, users don't want to pay. If they have fantastic product for free, they will be using it, and you're going to see a lot of user traction. And to make them pay, it's very hard. Especially, for example, in India, right? And we've seen many examples when people were raising a lot of money, proving to VCs that they can convert those free users into paid users, and they failed because people retention goes down, people kind of disappear from a platform. So that's why it's very important to think about the business model from the very beginning and to think how and for what users are going to pay going forward. That's why kind of both. Retention and a revenue. Because without it, it's just impossible to build a solid business.
I think in 2022, valuation is sort of the key word that's been tossed around everywhere, right? So starting with you, Anton, how do you value a company that you're investing in?
I think team is important. Look at the team. We get references on founders. We look a lot into unit economics, cohorts. We try to understand how big is the opportunity. and we try to understand how scalable is the business. And of course, we kind of apply DCF, peer group analysis, and so on and so forth. I think the team is the most important part. And of course, like for us, unit economics, it's the most important. It's the most important, yeah.
So I mean, I'll give a very simple way of looking at it. So I think, a venture-worthy company should be a company that should be able to reach $10 million of revenue in 5 years. And if you look at the average, basically valuation models over the past 20 years, that company by that time will be worth $100 million by applying, a 10x gross profit or revenue multiple if the gross profit is very close to the revenue multiple. Then you go, basically you look at that business model and you see how convinced are you with it. You take whatever haircuts, and you would want to be able to achieve your 10x on that. So you calculate it backwards and see how much you need to pay now in order to get that. But then valuation is just one term in a term sheet. So there are other terms, and at the end of the day, it's got to be something that an investor is willing to pay, and a founder or a company is willing to accept. But what we've seen is that companies where people do not think how are they going to create that 10x return, and if you end up with 2x return, you should be very happy. But that some of the companies that you invest in are not going to go anywhere, and the business plan that they provided is more of a fiction story. Like as they say, Excel is the best fiction writing tool ever invented.
Sid, your thoughts on the matter, valuation?
I think we invest much earlier. We're not a late stage fund. And so unlike team, what we look for is the founder. I think in India, there are many mousetraps. And so any market that you decide to invest in can be seen as a significantly large market. So we're very founder. We're looking at the founder, and a lot of the decision is being made on the founder. And to this point, I think the business plans we look at, there's a very good chance that so much is going to be different when we have to exit, that going backwards and trying to making any kind of guess or looking at unit economics at that particular point is a little bit more difficult to do for us. And so we look at the founder, and quite honestly, valuation then becomes a subjective matter more than an objective matter very early. And we want to own a certain amount. We want to make sure the founder has a certain amount. We want to make sure that the founder has enough money to de-risk the major risks at that time that we believe and they believe together are those risks. And therefore, we'll be able to go to Winter Capital and raise more money.
No, I think that I agree with your statement that Excel is a fiction, and all the time business plans are completely wrong. That's why the team is important, and product market fit very, very important to kind of de-risk. Not completely, you cannot de-risk completely, but at least to meet somewhere halfway. And we don't target actually 10x. We hope to target 10x, but usually for late stage VCs, it's kind of 4x, 5x that we target at.
Awesome. Okay, my last question for the day. Since we're in Abu Dhabi, how do you view the Abu Dhabi ecosystem for both startups and VCs in terms of competition and deal flow? And what is your outlook on of the Abu Dhabi market in the future, let's say over the next 5 years or the next decade?
Look, Abu Dhabi is a wonderful place to build a company in. I think the infrastructure that has been built into the city, the quality of life in the city, and sort of the emerging ecosystem, provides for a great compelling reasons for founders to seriously consider being in Abu Dhabi, especially as the different elements of the ecosystem being built by the government come into place. Obviously, if you're in Abu Dhabi, then you're targeting the UAE market. The UAE market is sort of a developed, advanced market, so competition is high, and it's not as big as some of the other markets in the region, such as Saudi Arabia. So it's important, if you're in Abu Dhabi and building something for, basically the Saudi market, building something for the Indian market or other markets in the region, I think, it provides for a very, very compelling composition and argument for founders, their families, VCs, to all be here at least, they can call a place home, but they'll be all over the place.
We're run a bit over time, but Sid, your thoughts on this?
Well, I agree. I'll just very quickly say that one thing I think is very encouraging over here is that no matter where you're building your startup, and we say this to a lot of our founders, a lot of the ecosystem here allows for a lot of experimentation and a lot of, especially for consumer companies, to see how you can take your product further, hiring people from many different areas, bringing them down to Abu Dhabi. The government support and efforts, I think, allows you to experiment a lot more with a lot of things that you want to do and then take them back to other countries. So I think that's really exciting. That's one of the more exciting things for us to look at.
Anton, we'll close with you.
I think, like, a long time ago, I've read one interesting book called Where Good Ideas Come From. And that book said that innovations or inventions, they're not coming from like one scientist and in one lab, as in the movies, for example. But they're coming from a community. So, and I think that ADGM kind of started developing a community, and if they continue doing so, creating a community, it will attract more startups, it will attract more ideas, it will attract more investors, and it will continue developing even at a higher pace than we see now. Well, one of the reasons Winter is moving here, so from other locations, and we're going to have our head office here, and we hope that community will continue growing going forward. So, though it's very hot here, honestly.
Thank you so much, Anton. Thank you to our wonderful audience for attending. A big round of applause for our panelists, please. Thank you so much.
Thank you very much.
Thank you.